Okay, picture this. There's a clock ticking down, but it's not for New Year's. It's for the entire global economy.
Our sources lay out this really chilling scenario. If the US government somehow missed just one debt payment, maybe even accidentally, the whole system, the global financial system, could basically implode. We're talking less than 48 hours.
Yeah, it sounds like something out of a movie, but the mechanics are real. Banks freezing up, credit markets seizing completely. Think about everything you rely on financially. Your mortgage, sure, but also global trade, supply chains. It could all just grind to a halt instantly.
Right. So let's dig into this. We're doing a deep dive today on something that usually sounds pretty dry, the U.S. national debt, which,
Wow.
is huge. What is it now? Over $38 trillion.
North of that, yeah.
But the point our sources make, and it's fascinating, is that this number isn't just some political talking point or, a bill we owe. It's actually the bedrock, kind of the hidden plumbing of global finance. Weird.
Right.
It is paradoxical, but that's absolutely right. We're trying to look underneath all the noise at this invisible structure that holds so much up. So our mission here is to really understand why. Why are U.S. Treasury bonds seen as the most critical financial thing on earth? And crucially, what happens when the trust that underpins it all, trust built over centuries, starts to look a bit shaky? Maybe because of politics or just shifting global confidence.
And our sources, which lean heavily on financial history and analysis, argue something pretty radical. They say U.S. debt isn't some unfortunate liability the world puts up with. No, it's a product, a necessary product the world demands. Its reliability, the absolute faith that the U.S. will always pay, that's basically the firewall between business as usual and total systemic chaos.
Okay, let's tackle that 48-hour timeline first. It sounds extreme, I know, but it comes down to how money actually moves. Liquidity. If the U.S. were to default, and that just means missing one payment on a treasury bond, the system wouldn't wait for some official announcement. The confidence, the trust, it just evaporates instantly.
But why? Why is a promise from the U.S. government so much more important than, say, Germany's promise or Japan's?
Right.
Why is one missed payment a global catastrophe?
It all boils down to one word: collateral. Treasury bonds, T-bonds, they're treated globally as the only truly risk-free asset, the gold standard of safety, if you will. They are the ultimate guarantee, the bedrock collateral used in almost every major financial transaction globally. Think of it like the lubricant in the financial engine. Without it, everything ceases.
So you're talking about things like the repo market, that massive kind of shadowy market where banks trade trillions overnight.
Precisely. The repurchase agreement, or repo market, trillions change hands there daily. And the collateral securing those transactions, it's almost entirely U.S. Treasury bonds. This market is what lets banks manage their daily cash, allows corporations to hedge currency risk, everything. Now imagine if T-bonds suddenly weren't risk-free because the U.S. missed a payment. That collateral, it's instantly questioned, maybe worthless. Banks would immediately demand something else, something safer, or they'd just stop lending altogether.
And that's the domino effect. The core collateral gets tainted. So credit lines everywhere freeze up. Markets stop trusting each other. You'd see margin calls popping up everywhere, demanding cash that nobody can get because lending has stopped. Our sources say the dollar would crater as everyone scrambles for, well, who knows what. And within days, the U.S. government itself couldn't pay its bills. We're talking Social Security checks, military salaries, basic government functions. Gone.
And this isn't purely theoretical. We've had little previews of this fragility. Remember that 1979 incident? It was just a processing glitch, a technical problem with treasury payments, delayed things for a few days.
Not even a question of money, just wires crossed somewhere.
Exactly. But interest rates spiked immediately. Markets got spooked. And for years after, U.S. debt was treated just a tiny bit differently. The cost of borrowing for the U.S. went up just because of that brief uncertainty.
And fast forward to more recent times, like 2011. That political standoff over raising the debt ceiling. It got so close to the edge that the U.S. actually got its credit rating downgraded for the first time ever.
Right. And markets tanked.
Yeah.
Trillions lost in value, just because politicians were playing chicken with that fundamental promise.
It really highlights the point from our sources. These are crises of psychology.
Yeah.
They're built entirely on this one, single belief.
Yeah.
The U.S. always pays.
Yeah. And to understand how incredibly powerful that belief became, you have to rewind all the way back to the beginning. Like 1790, Alexander Hamilton, first Treasury Secretary. The country is brand new, just fought a revolution, and it's drowning in debt. Debt from the states, debt from the Continental Congress.
So the logical thing, maybe, for a new nation would be to just say, okay, war debt, we're wiping the slate clean, start fresh. Why didn't Hamilton do that?
Because he had this radical idea. He saw the debt not as a problem to erase, but as raw material to build something invaluable: credibility, trust. Hamilton insisted the new federal government take on all that old debt, every single dollar, and promised to pay it back with new, reliable treasury bonds.
Wow. So imagine you're like a farmer who got paid in some useless state IOU during the war.
Exactly. And suddenly, this new, powerful central government says, that paper you're holding, it's good, we'll pay you in full.
That's where the faith starts.
That's the bedrock. Hamilton's gamble worked. It showed the world, especially those skeptical European bankers, that the U.S. was different. It was reliable, a safe bet. This made U.S. debt desirable, a premium product, even back then. And that very debt became the engine for growth financing the Louisiana Purchase, canals, railroads, you name it.
Okay, so that established the principle. But how did it go from being a reliable national asset to the absolute anchor of the global system? That feels like a big leap.
It was a gradual process, but the major turning point was World War II, and specifically the Bretton Woods Conference in 1944. 44 nations got together trying to figure out how to rebuild the world economy after the devastation.
And the U.S. was really the only major economy left standing, wasn't it? Infrastructure intact, huge industrial base.
Right. And critically, it held about 2/3 of the world's official gold reserves. It was the only game in town, financially speaking. So at Bretton Woods, they agreed to anchor the entire global financial system to the US dollar. And the dollar, in turn, was convertible to gold at a fixed rate, $35 an ounce.
So if you were another country, say France, and you wanted a safe place to park your national savings, your reserves, you'd buy U.S. Treasury bonds because they were backed by dollars, which were backed by gold held securely, supposedly, in Fort Knox.
Exactly. U.S. debt literally became the world's savings account. It provided that essential risk-free asset everyone needed.
But that system, the gold peg, it started to fray, didn't it, by the late 60s?
It hit a fundamental problem. The U.S. was spending massively overseas the Vietnam War, and at home, the Great Society programs. Dollars were flooding out into the world. This created something economists call the Triffin dilemma.
Okay, sounds technical. Bring that down for us. What's the core conflict there?
It's basically this. If your currency, the dollar, is also the world's main reserve currency, you have to supply enough of it for global trade. That means running deficits, sending dollars out. But the more dollars floating around the world, the harder it is to maintain the promise that every single one of them can be swapped back for gold at that fixed $35 price. Foreign central banks started getting nervous. They saw the U.S. printing dollars and started thinking, maybe we should cash in our dollars for gold now while we still can. The gold reserves in Fort Knox started draining.
So the U.S. basically had to choose: keep funding its global role and domestic spending, or keep the dollar tied to gold. Couldn't do both.
Correct. And in August 1971, President Nixon made the choice, unilaterally. He announced the U.S. would no longer convert dollars to gold. Just like that, he severed the link, ended the Bretton Woods system.
Whoa! So overnight, the dollar wasn't backed by gold anymore. What was it backed by?
Nothing physical, just faith, confidence, the full faith and credit of the U.S. government. The promise that the government would always pay its debts, which were issued in dollars. This move created the financial world we live in now. Not a gold standard, but effectively a debt standard.
And this is where the paradox gets really mind-bending. If the dollar's value rests entirely on the U.S. promise to pay its debts, then the U.S. actually needs to keep issuing debt, right? So the world has this safe dollar-denominated asset to hold on to.
You got it. It's wild. The U.S. could now, in theory, create almost unlimited credit just by issuing treasury bonds, as long as the world kept believing in its stability and its promise to pay. T-bonds became the safest thing on earth, not because of math, but because everyone agreed they were. Every major bank, central bank, pension fund, they all built their systems around this assumption. So the debt itself stopped being just a liability. It became the essential product, the infrastructure.
Which leads to this unbelievable conclusion. When we talk about paying down the national debt, we're talking about something that sounds responsible. But if the U.S. actually tried to pay it all off, eliminate it entirely, that would collapse the whole system.
How?
Think about it. If the U.S. paid off all its treasury bonds, where would all that global money go? Where would central banks park their reserves? Where would pension funds find that ultra-safe asset they need to guarantee retirements? There'd be no T-bonds left to buy. The world needs a constant supply of this safe product. If it vanished, it would starve the system of its core collateral, its safety net. It would force everyone into riskier assets, creating chaos. No debt means no safety.
Okay, that really reframes the whole debate. But even if the debt needs to exist, the current situation, It feels different. The numbers were getting scary.
They are. That $38 trillion figure is one thing, but look at the interest payments. They're soaring, heading towards $1 trillion a year. Just interest.
$1 trillion just to service the debt. Yeah. To put that in context, it's nearly double the entire budget for the Department of Education. It's almost as much as the entire U.S. defense budget. We're now effectively borrowing money just to pay the interest on money we already borrowed. That cycle gets dangerous.
And the risk isn't just the numbers anymore, is it? It feels increasingly political. Our sources are really clear on this. They see using the debt ceiling as a political weapon, what they call hostage taking, as maybe the single biggest threat. Because like you said, the global markets don't care why the payment was missed. They just care that it was missed. Confidence shatters regardless of the reason.
Absolutely. And that political brinkmanship, it's not just talk. It's having real effects. We're seeing major foreign holders of U.S. debt, think China, Japan, Saudi Arabia, they're gradually trimming their holdings of treasuries. It's not necessarily hostile. It might just be prudence, hedging against political dysfunction in Washington. And look at central banks around the world. They're quietly buying gold again after decades of relying mainly on dollars. It's like an insurance policy.
So, if Washington keeps looking unstable, what stops other countries from just ditching the dollar entirely? Is that possible?
Not overnight. The system is just too deeply intertwined. Everyone relies on dollars for trade, for reserves. It's like trying to change the oxygen everyone breathes. But they are building alternatives, slowly, systematically. Countries like Brazil, India, China, they're pushing for trade deals, using their own currencies, bypassing the dollar. It's not really a direct fight against the dollar. It's more like quiet diversification. The world is trying to become less dependent on the American financial system.
So the nightmare scenario isn't necessarily that America runs out of money. I mean, it can print dollars.
Right.
The real disaster happens if America runs out of cooperation.
Yeah.
If domestic politics basically sabotage the global financial plumbing.
That's exactly it. It would be a crisis of governance, not a crisis of solvency. And confidence, once it's broken, it's incredibly hard to repair. Fully. Maybe never. Think about history. Great empires, Rome with its denarius, Britain with the pound sterling. Their currency was trusted only as long as the empire itself was seen as stable, competent, reliable.
So the U.S. might be facing the end of an era, not because the math finally fails, but because the story does. The belief that the American system is uniquely stable and eternal.
That's the argument. The biggest risk isn't a sudden dramatic collapse. It might be slower, more like global indifference. The world might not need to fight the dollar. It might just gradually stop needing it quite so much, arranging its affairs differently.
Wow.
The United States built this incredible global economic position on essentially infinite debt backed by infinite trust. But trust, that's the one currency you can't print. And once it's truly lost, no government can just borrow it back.
That is definitely the thought to sit with. Think about this next time you hear about debates over the debt ceiling in Washington. It's not just abstract political theater. According to our sources, that failure to agree, that dysfunction, directly impacts the perceived risk of the asset that underpins everything. It affects the rate on your mortgage, the stability of your pension fund, the cost of goods shipped across the ocean. It's all connected. It's all built on a promise. And the world is watching to see if that promise still holds.